Welcome back to course number 7, Basics of Investing. In this lecture, we're going to introduce 4 of the most common types of investments: stocks, bonds, mutual funds, and ETFs. By the end, you'll have a clearer understanding of what they are, how they differ, and how they fit into an investment strategy. When people talk about investing, these 4 stocks, bonds, mutual funds, and ETFs come up most often. Each has its own level of risk, return, and purpose. Knowing the basics of these options helps you make informed decisions about how to grow your money over time. Stocks represent ownership in a company. When you buy a share of stock, you own a small piece of that company. If the company grows and earns profits, your stock may increase in value and you might receive dividends. Stocks offer high potential returns, but also carry higher risk because their prices can rise and fall quickly. For example, if you buy stock in a well-known company like Apple or Netflix, and that company performs well, the value of your shares can rise significantly. But if the company struggles, your investment may lose value. This makes stocks best suited for long-term goals, where you can ride out ups and downs. Bonds are essentially loans you give to companies or governments. In return, they promise to pay you back with interest. Bonds are generally less risky than stocks, but they also offer lower returns. They provide steady income and stability, making them a good balance in an investment portfolio. Imagine buying a $1,000 bond from the US government. Over time, the government pays you regular interest, and at the end of the bond's term, you get your $1,000 back. Bonds are seen as safer than stocks, especially government bonds, but their growth potential is limited. A mutual fund pools money from many investors to buy a mix of stocks, bonds, or other assets. A professional manager decides how to invest the fund's money. Mutual funds offer diversification, spreading out risk by investing in many different companies or bonds, but they usually charge management fees. Let's say you invest in a mutual fund focused on technology companies. Instead of buying stock in just one company, your money is spread across dozens of companies. If one company does poorly, the others help balance out the risk. This makes mutual funds a good option for beginners. ETFs, or exchange-traded funds, are similar to mutual funds because they hold a mix of investments. The difference is that ETFs trade on stock exchanges just like individual stocks. They often have lower fees than mutual funds and can be bought or sold throughout the day. ETFs combine diversification with flexibility. For instance, an ETF might track the S&P 500, which is an index of the 500 largest US companies. By investing in that ETF, you're essentially buying tiny pieces of all those companies at once. This gives you broad exposure to the stock market in a single investment. Let's compare them. Stocks: high risk, high return, ownership in a single company. Bonds: lower risk, steady income, but limited growth. Mutual funds: managed, diversified, but with fees. ETFs: diversified, flexible, and often low cost. Together, they form the building blocks of most investment strategies. Consider a student named Jordan who wants to start investing. Jordan puts some money into stocks for long-term growth, buys a bond for stability, and invests in an ETF for diversification. This mix allows Jordan to grow wealth while balancing risk and return. To summarize, stocks, bonds, mutual funds, and ETFs are the core investment types you'll encounter. Each has its strengths and weaknesses, but when used together, they can help you build a strong portfolio. Start small, learn as you go, and remember, investing is about balance, patience, and long-term growth. This concludes our discussion about the stocks, bonds, mutual funds, and ETFs. In the next lesson, we will learn about the risk versus return. See you then.